5 seconds to the open. Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to this episode of the Follow the Money podcast. I'm Jerry Robinson. This is episode number 514. Today, we're talking about the power of dividend growth. You know, a lot of investors spend nearly all their time focused upon stock prices, right? They want to know what's going up and what's going down and what might make the next big move. But over time, some of the most dependable wealth that has been built in the stock market has come from owning quality companies that not only pay dividends, but consistently raise them year after year. So in today's first segment, we're going to take a look at Dividend Achievers, Dividend Aristocrats, Dividend Kings, and we're also going to talk about why dividend growth matters more than simply chasing a high yield. I'll also share one of my favorite dividend growth ETFs that I actually invest in. And we'll also talk about how our powerful Dividend Aristocrat Leaderboard helps our members identify the strongest names from both a fundamental and technical standpoint. Then in segment 2, I'll share my latest market insights and what I'm seeing in the charts right now. All of that's coming up next on Follow the Money. Let's get started. All right, on today's episode, I want to talk about something that's not really that flashy, right? It's not exciting in the way that artificial intelligence stocks are exciting. It's not going to generate the same kind of headlines as Bitcoin or quantum computing or the latest stock that's just doubled in the last few weeks. But it has quietly helped build an enormous amount of wealth over the years. What I'm talking about is dividend growth. And notice, I did not merely say dividends, I said dividend growth. It's a big difference between buying a stock simply because it pays a high dividend today and owning a strong business that has the ability to increase that dividend year after year. That difference can determine whether you're building a dependable and rising stream of income in the future or whether you're just walking straight into a dividend trap. And believe me, there are lots of dividend traps out there in the market. So what I want to do in this first segment is just slow down for a few minutes and talk about why dividends really make a difference for the average investor out there, and specifically why dividend growth matters even more. So let's just talk about stocks. When you buy a stock, there are really two primary ways that you make money. The first is called capital appreciation. You buy the stock for $50, it increases to $75, and you made money through the increase in the stock price. That's the part that everybody gets. Everybody focuses upon that. In fact, that's what they're discussing on the financial television all day long. What's up, what's down, what's breaking out, what stock is going to make the next big move. And that's fine. Obviously, that's one way to make money with stocks, but there's a second source of return. The company may also share a portion of its profits with you in the form of a dividend. So you own part of the business, and the business sends part of its cash back to you. And over long periods of time, dividends have represented a very meaningful portion of the total return generated by the stock market. Now, the exact percentage changes to really kind of depend upon the period you're studying. But the point is, when you remove dividends and the reinvestment of those dividends from long-term stock market returns, the result falls dramatically. And that's because the dividend is not merely income to the investor, but it can also become fuel for compounding the returns in that stock. See, the company pays you a dividend. If you reinvest that dividend and purchase more shares, those additional shares will begin producing dividends of their own. And then if the company raises its dividend, every share you own begins producing even more income. Then you reinvest that larger payment, buy still more shares, and the process continues on and on. The reason why many people don't see how powerful this can be is because it starts very slowly. That's probably one of the main reasons why so many people tend to ignore it. When you get those first few dividend payments, they're not going to feel particularly impressive. You get a few dollars here, a few dollars there. It doesn't look like much is really happening. But compounding rarely looks impressive in the beginning. It begins to look really impressive later, however. Well, one of the easiest examples to think of or illustrations would be just to think about planting a small tree. I planted a small tree here on my own property many years ago. And in the beginning, in the early years, it didn't provide hardly any shade. It looked pretty silly. It was very tiny, and it didn't produce any fruit, right? And if I had sat around and looked at that tree for a while, I'd think to myself, well, this thing is probably not going to produce anything meaningful or at all. But beneath the surface, the roots were being established, and the trunk was growing stronger, and the branches were spreading. Then one day, that small tree had become something substantial. And dividend growth can work the same way. So you're buying shares, you're reinvesting income, the company is raising its dividend payout, and your share count keeps growing. And so therefore your income stream keeps getting bigger. But that leads us to the very first major mistake that many investors make when it comes to dividends, and that is they chase yield. They pull up a list of dividend stocks and they sort the list from the highest yield to the lowest yield. Then they begin buying whatever appears at the top. It sounds like a smart idea when you think about it. You obviously would want to have the highest dividend if you could, but that's actually a very dangerous way to invest. If you've ever done it, you probably know. A high dividend yield is usually not a gift. It's usually a warning sign. I mean, remember, the dividend yield goes up when the stock price falls. So a company may appear to be offering an 8 or 10% yield, but the yield may only be that high because the stock price has literally just imploded. Of course, you should ask why the stock price is down. I mean, maybe earnings are falling. Maybe the company is carrying too much debt, or maybe the free cash flow is weakening, or maybe the payout ratio is becoming unsustainable, or maybe the market believes a dividend cut is coming. My point is the yield tends to look more attractive at the very moment that the underlying business is typically becoming less attractive. That's what they call the dividend trap. And I have seen investors fall into this trap over and over again. On the surface, it looks like they're buying a nice income stream, but in reality, they're buying a deteriorating business. And then the dividend might be reduced or eliminated, and then the stock falls even further. And then the investor loses both the initial income he was hoping to get and a substantial portion of the original investment. So let me suggest that the right question for the dividend growth investor is not simply, what is the yield? That obviously is important. But the better first question is, how safe is the dividend? How likely is it that the dividend will grow? Because I would much rather own a healthy company paying a 3% yield with the ability to raise that dividend consistently over time than to buy into a troubled company that pays an 8% dividend with no room for growth and a very real possibility of a dividend cut. And that's where dividend growth becomes so important. Let's just imagine two companies, Company A, Company B. Company A pays a 6% dividend yield today. That sounds pretty attractive, but the company is barely growing. Its debt level is pretty high, its payout ratio is stretched, and the dividend only grows by 1% a year if it grows at all. Then there's Company B, which pays a yield of 2.5%. Now that obviously doesn't sound nearly as exciting, but Company B has been growing earnings, it has strong free cash flow, it has a healthy balance sheet, and it's been raising its dividend by 8% per year. So, which company is likely to serve you better over the next 10 to 20 years? Company A will give you more income today, but Company B may eventually produce far more income because the dividend keeps growing each and every year. And as an investor, that's really what you need. You need rising income to help protect you from the eroding factors on money, including things like inflation. That's especially important for retirees. A fixed stream of income may sound safe, but if the cost of food and housing and insurance and healthcare and utilities continues rising, that fixed income buys less every single year. This is where a growing dividend gives you the possibility of an income stream that rises over time. Of course, in the stock market, there are zero guarantees, right? A dividend can always be reduced or eliminated, but a financially strong business with a long record of increasing its dividend on an annual basis can be an important part of a long-term income strategy. Now, let's talk about some of the categories that investors use to identify consistent dividend growers, because again, the key here is that you want stocks that are not just paying a dividend. You want stocks that are growing their dividend every single year. And we have names for these kinds of companies. The first kind of a company that does this, we would call a dividend achiever. A dividend achiever is generally a company that has increased its dividend for at least 10 consecutive years. Now, that may not sound like a lot, but think about what it means. That means the company has continued raising its dividend through different economic environments, right? Interest rates might have been different at different times. Inflation might have gone up and down. There probably has been a few episodes of big market volatility. Maybe even the business has been disrupted in some ways. And so if it continues to raise its dividend on an annual basis for a full 10 years in a row, then it's considered a dividend achiever. And that's a great place for a company to be. Then we have Dividend Aristocrats. These are some of my favorites because these are companies within the S&P 500 that have increased their dividends for at least 25 consecutive years, along with meeting a few certain size and liquidity requirements. Now, 25 consistent years of raising dividends tells you that the company has continued rewarding shareholders throughout recessions, bear markets, financial crises, wars, all kinds of political and geopolitical turmoil, and all the major technological shifts that come along with our modern age. Now, just because a stock happens to be a dividend aristocrat doesn't mean it's automatically a good buy today, right? And in fact, right now, as we speak, in July of 2026, as I record this episode, there are really only 69 stocks that are considered to be S&P 500 dividend aristocrats. That's a very small number when you think about the thousands of stocks that are out there. That's really quite a small number when you think about it. We actually track all 69 of those stocks on our website through our Aristocrat Leaderboard. I'll talk about that here in just a few minutes. And then we have the Dividend Kings. A Dividend King has increased its dividend for at least 50 consecutive years. A half of a century. Think about the economic changes that have occurred over the last 50 years, where we've experienced severe inflation, oil shocks and recessions, market crashes, global pandemic, and incredible changes in technology. And through all of it, these Dividend Kings continued raising the amount of cash that they paid to shareholders each and every year. It's quite remarkable when you think about it. So here's the simple way to remember it. 10 consecutive years of rising dividends makes a company a dividend achiever. 25 consecutive years of dividend increases makes it a dividend aristocrat. And 50 consecutive years or more of rising dividends places the stock among the Dividend Kings. Of course, we need to use some caution here because when you look at a long history of dividend growth in a company, what that tells you is that that company has accomplished a great deal in the past, but it does not automatically tell you whether the stock is attractive today. Can it continue that for the next 50 years as well? I mean, remember, these stocks are like all other stocks. They can become overvalued. They can experience declining earnings. They can still carry too much debt. They can enter long-term downtrends. And perhaps worst of all, they can eventually cut their dividend. And that's why you simply cannot just buy every company with a long dividend history and assume that the work is done. You still have to study the business. Where does that dividend come from? It comes from cash flow, right? The company has to sell a product or a service and generate sales and control its expenses, earn a profit, and then convert enough of that profit into real cash. And then the management team has to decide how that cash should be allocated. They could use that cash to reinvest into the business. They could use it to reduce debt or to repurchase shares, or they could take part of it and return it to shareholders through dividends. So what I'm saying is that if you're looking for a sustainable dividend, it must be supported by the underlying business. So when I evaluate a dividend-paying company, I want to look at earnings consistency. I want to look at free cash flow levels. I also want to know how much of the company's earnings are being paid out as dividends. That's called the payout ratio. That's a very important ratio that we talk to our members about to help them understand how to identify which companies may be right and which companies may not be so right if you're trying to identify companies that are going to continue to be able to pay out increasing dividends. I also want to look at the company's debt. I want to know whether the company has a durable competitive advantage. Does it have a good economic moat? So too, I want to know if the company is actually still growing, because a company cannot increase its dividend faster than its underlying business forever. Eventually, the cash has to come from somewhere. Now, one of the ways that I've found to simplify this process is to search out really great dividend growth ETFs. And one of my favorite dividend growth ETFs is the Schwab US Dividend Equity ETF, ticker symbol SCHD. Now, I've owned SCHD for some time, and I view it as a long-term holding. What I like about SCHD is that it does not simply go out and buy the 100 highest yielding stocks that it can find. It focuses upon established dividend growth companies, but it also measures things like the quality of the business, the financial strength of the business, the cash flow, and on and on. Obviously, this is very important to an investor. You're not just simply looking for income, you want quality income. You want the companies paying that income to have the financial strength to keep paying it, and ideally to keep increasing it over time. And that's what this ETF basically does. So too, dividend growth ETFs like SCHD can provide diversification. So instead of trying to choose one or two dividend stocks and hoping that nothing goes wrong, the investor can gain exposure to a broad portfolio of dividend growth companies. What I also like about SCHD is that it's such a low-cost ETF, which matters over long periods of time. Now, SCHD is actually outperforming the S&P by about 2x so far year to date. It's up nearly 20% versus the S&P's about 9% year to date. But it's not going to outperform every year. There will be periods when growth stocks are just racing higher and dividend growth stocks appear to be very boring. We've seen many periods where tech dominates the market and a fund like SCHD just kind of lags behind. But it's not really a replacement for tech, right? It kind of serves a different role. So I don't view a dividend growth ETF like SCHD as a replacement for all growth stocks. I view it as a complement to the growth stocks that I already own. I like to own companies with really strong growth potential while also owning a portfolio of mature cash-generating businesses that return part of their profits to shareholders and increase that every single year. What I like about dividends, of course, is that when the market falls, the dividend doesn't necessarily disappear. The stock price may go down, but the investor keeps receiving the income. And that income, which really doesn't change unless the dividend goes down, can be reinvested at lower prices, purchasing more shares and potentially increasing the future income stream. That's the idea behind getting paid to wait with these dividend growth stocks. But I want to repeat a very important warning here about dividend stocks because I don't want you to get the wrong idea. If you haven't really invested in dividend growth stocks before, you have to realize they are still just stocks. Despite having perhaps very strong management and a great product or service that has stood the test of time, they still can fall, right? And they can become overvalued and they can cut their dividends even, right? I've seen it happen. We've seen Dividend Aristocrats. In fact, we just we saw a couple of Aristocrats leave the Aristocrat Leaderboard earlier this year. The number kind of is in flux. Right now we have 69 Aristocrats. In the past, there were less than that. In the past, there's also been more than that. So the number kind of changes on an annual basis. And that happens when a company cuts its dividend and then loses its status as an aristocrat or a king or an achiever. But remember, a dividend is not a contractual obligation in the same way that an annuity payment is, right? When you buy an annuity, for example, you get a contractually guaranteed income that you are legally and contractually entitled to. With a dividend growth stock, the board of directors of the company can reduce or eliminate your dividend. Right? So don't treat a dividend stock as if it were some sort of guaranteed annuity or some sort of contractual guarantee. And obviously don't assume that a high dividend yield is the smartest way to go every single time. Usually a very high yield signals more risk. Now that brings me to our Dividend Aristocrat leaderboard here at Follow the Money. We built this leaderboard because the Dividend Aristocrat label alone is really not enough. There are many strong companies on the Aristocrat list, but they are not all equally attractive at the same time. Some may have stronger earnings, others might have better balance sheets, some may be raising their dividends at a faster clip, some may be in healthy technical uptrends, others might be breaking down technically or maybe losing momentum. So our leaderboard ranks these companies using both fundamental and technical factors. So the list is not just based upon has the company raised its dividend for 25 consecutive years. All 69 stocks on the list have. What the leaderboard does is say what's happening now, right? Is the company growing? Is the dividend well covered? Is the balance sheet healthy? Is the stock in an uptrend? So our leaderboard basically helps us evaluate which of those companies appear strongest today. And our technical rankings really help us avoid blindly stepping in front of a falling stock simply because the yield looks attractive. That can be tempting, but it often fails as a smart investment strategy. So what's the main takeaway here? Well, basically, do not chase the biggest dividend yield you can find. Focus on the quality of the company. Focus on the safety of the dividend. And focus on the ability of the business to increase that dividend over time. I think a great place to start would be looking at Dividend Achievers, Dividend Aristocrats, and Dividend Kings. And as I mentioned, one of my favorite dividend ETFs out there is the Schwab U.S. Dividend Equity ETF, which provides a very simple and diversified way to gain exposure to these types of companies that grow their dividends over time. And of course, our Dividend Aristocrat Leaderboard helps our members identify which aristocrats are currently demonstrating the strongest combination of fundamentals and technicals. I think one of the biggest takeaways, though, is simply that when you do begin to invest in dividend growth stocks, you are really working on not just creating a single payment, but a growing stream of payments over time, while the strong business underneath it all continues to create value. And the results from that can be extremely powerful. All right, so when we come back, I'm going to take a look at the latest action in the financial markets. I'll talk about some of the trends I'm watching and what investors should be paying attention to right now. Stay with me. We'll be right back. Hey friends, Jerry Robinson here from followthemoney.com. Before we continue with today's podcast, let me just mention something really quickly. If you've been listening to the podcast for a while and you're starting to think more seriously about your own situation, your investments, your retirement plan, and how everything is actually structured, there comes a point where it helps to talk it through with someone. And that's why we created our Follow the Money Advisor Referral Service. We work with a network of trusted financial professionals across the country, and we can connect you with someone who can help you take the next step, whatever that looks like for you. Maybe it's reviewing your current retirement plan, or maybe it's putting a real income strategy in place, or maybe you just have a simple question like getting a life insurance quote. If that sounds helpful, you can learn more at followthemoney.com/advice, or just give us a call at 800-609-5530. No pressure, just a chance to get some clarity around where you are and where you're going.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to one of the longest running personal finance podcasts on the planet. You're listening to Follow the Money with Jerry Robinson. Grateful to have you here. I hope you enjoyed that last segment all about the power of dividend growth. What an interesting topic, really, for those who are out there. If you're a trader, it might not be something that you think about, right? For many years, as I was growing as a trader early on, I didn't really think about investing, and certainly I didn't think about dividend growth. But it really is one of the most powerful things that you can do when it comes to investing in the market. So with all that said, what I want to do is I want to dive into this segment 2, and I want to talk about some of the latest insights that I want to share with you from the markets as we see them. I'm looking through many of the major market charts that I like to follow, the S&P 500, the Nasdaq 100. We're going to look at gold. We're going to look at the dollar and even Bitcoin. Just want to give you a quick thumbnail sketch of what we're seeing to kind of provide you with some commentary to help you see how we're seeing the markets right now. If you look at the S&P 500, which is really the big behemoth market that, again, the whole globe tends to follow when they look at U.S. stocks. If they want to know what the U.S. stock market is doing, of course, you can look at the Dow. That's just 30 stocks. You can look at the Russell 2000, but that's just small cap stocks. But the S&P 500 is composed of 500 large cap stocks. This is really going to tell a better story of what's happening in the market. And if you look at the S&P 500 right now, we are continuing to hold real steady at a rising 50 SMA, a rising 50 simple moving average. That's a very important technical level that we tend to find support at after we pull back. So the S&P sitting just below a brand new record high. I mean, it's just sitting just below it. We're within maybe 100 to 200 points of actually hitting a fresh record high. And we are holding above a rising 50-day moving average, which to me signals good strength here for this particular market. The market doesn't look like it's getting ready to roll over. It doesn't have that look, although even here we are in the summertime where you tend to have kind of a summer slump. We haven't seen that too much. The market has been going sideways a little bit since hitting that brand new all-time high just a little bit ago. In fact, it was just back in May where we hit that new peak, and we've been grinding sideways, consolidating. But overall, everything looks constructive with solid volume coming into the market. If we look at the percentage of stocks in the S&P 500 trading above their 200-day moving average, it's right around 66%. So it's about 2 out of 3 stocks in that S&P 500 that are trading above their 200-day moving average. And if you know what that means, you know that that's actually bullish. When a stock is above its 200-day moving average, it's considered to be bullish. And so that means, right now, 2/3 of stocks are showing that. Doesn't mean that it's overheated. Usually when we get to about 80% of stocks in the S&P above their 200-day moving average, that's where I tend to get a little more cautious. That's where you tend to be getting a little stretched in terms of market breadth. Another market that I follow and I've been following for years and I invest in is the Nasdaq 100. It's one of my favorite markets because it's always tracking these top non-financial companies, typically, innovative companies, tech companies, which I really like to invest in. We hit a peak on the Nasdaq 108 all-time high back in May, just like the S&P. And since that time, we've been grinding sideways and finding some key support here just below its 50-day moving average. Unlike the S&P, the Nasdaq 100 has not been able to hold its 50-day moving average, and that 50-day moving average is even beginning to flatten out. But we still have plenty of support just below. So just looking here at QQQ, seeing that it's still holding on to many of its gains, especially that explosive rally we saw back in March when the market really just powered higher. Now, let's move on to physical gold, which is also beginning to show strength. Gold, which had fallen fairly sharply from its $5,600 level that was reached back in January, had fallen below its 200-day moving average. And it fell into this demand zone area between, say, $39.50 and $41.50, right around 4,000. And it was grinding sideways there for quite a bit. Well, we're starting to see over the last few sessions, we've seen some pretty good strength in the price of gold. Gold is beginning to rally up. What I would watch for is a resistance area of around 4,400, 43 to 4,400, and then all the way up to 4,500 is where the 200-day moving average is. So really 43 to 4,500, we should probably say, is the area to kind of watch out for more resistance here for this potential rally that may be trying to get started here in gold. Gold is still below its 50 weekly moving average. If we get a breakout above, say, 43.50 or so, which would bring us back above the 50 weekly, that would basically suggest a pretty big improvement in sentiment there on the yellow metal. Now, turning to the U.S. dollar. The U.S. dollar has also been holding in kind of a pattern here just above the 100 level. The U.S. dollar index, the key area we've been watching on this is 102. We haven't got up there. We got to 101.80. And as the dollar rises, what goes down? Gold. What else goes down? Silver and other things that are denominated in the U.S. dollar. When the dollar goes up, that just puts pressure on things priced in the dollar. And when the dollar goes down, it takes that pressure off. And so the dollar is kind of buoyed right now due to the fact that inflation still remains sticky. We have gotten some pretty decent prints lately suggesting that maybe things are improving. However, the main reason why all that matters is because of the Federal Reserve. The Federal Reserve, of course, has been expected to raise rates this year. Now, I continue to believe we're not going to see a rate hike this year. I don't think that's in the cards at all. But nonetheless, the market has been kind of gearing up for a potential rate hike. I expect a rate cut to come, and I think we could see that before the end of the year. But for now, the market still kind of anticipates that we're going to see probably at least one rate hike in the future, perhaps by the end of the year, and that's been helping the dollar kind of stay up. Once it becomes clear, in my opinion, if it turns out that I'm right, that the Federal Reserve is not going to hike rates, and in fact they're going to hold and or maybe even cut, I think you're going to see that dollar begin to weaken, and that, of course, will put a re-acceleration underneath the trends of the long-term trends of gold and silver and Bitcoin and many other assets for that matter. But in the meantime, I would watch out for that 102 resistance on the US dollar index. That's a key level that we keep our eyes on. The Russell 2000 also, the small cap index, has really been making up for lost time. It has been in big rally mode since last April, going back, I should say, back to April of 2025. So not the last April, but 2 Aprils ago. And we broke out above the 200-day moving average on the Russell 2000 back in the summer of 25. And we haven't, we've only pulled back to that area once since that time in any meaningful way. And that was earlier in March. Well, we didn't go really below it. And we held it. And now the Russell 2000 actually outperforming the Nasdaq 100. It's outperforming the S&P 500 year to date. Small caps really having a nice rally this year. Now, let me also talk about silver. Silver is also showing some similar kind of near-term strength on its trend. The long-term trend still remains up, but just barely. And right now, we've seen silver come all the way down from its January peak above 120 down to the 50 level, right? 55 or so. We have since come back up. We're going to be facing some pretty tough resistance at around $60 to $61. That goes up to about $63.50 or so. So there's going to be quite a test here for silver. We may have to meander a bit before it can really take off. But I do expect that silver is going to resume higher after this lengthy sell-off and consolidation of explosive move higher in the silver and gold markets. Silver especially. Silver also trading below its 50 weekly moving average. That number currently at about $65. So if you do get above $65 on silver anytime in the near term, which I don't think we will see that, it's a possibility, but if we do break out past all those resistance levels and take out the 50 weekly moving average and regain it, then that could also be a big sign of more money coming in to the silver space. Oil, unfortunately, has been back on the rise. I was just alerting our members that one of the more concerning areas of the energy market is the diesel price. Diesel fuel prices back above $5, and I think they're even rising now. Obviously, the gasoline prices affect, the average consumer. They affect drivers. They affect just the average, U.S. consumer. But the price of diesel really determines a lot more. It's a big input cost because so much of the big transportation that goes on around the country in terms of semi-trucks and other types of vehicles require diesel. And diesel fuel, with it going up, that's just going to continue to compound the issues with inflation. Oil, tracking the Invesco US Oil ETF DBO, is back at its May levels right now. Its May highs, we're getting back close to, if you can believe it or not. So oil showing some renewed strength. However, if you look at West Texas Intermediate, it's currently trading pretty well below its peak that was hit earlier this year of around 115, 120, well above 110. Also, Brent crude has been showing some renewed strength. It got up to around 115 or so earlier this year. It's back at about 94 after falling to nearly 70, earlier this month. So that's one area we've been watching. Also, yields have been up a little bit. The 30-year mortgage, average mortgage rate out there, about 6.5% we're seeing a lot of, that's just, it's causing issues in the overall market. Now, let me talk real quickly about Bitcoin before we close out this segment. Bitcoin has also been showing some renewed strength, similar to gold, similar to silver, and we are off of our July lows, which were down well below $60,000. Now we are back above the 50-day moving average on Bitcoin, and there's a really big resistance overhead at the 200-day moving average, which is declining. Right now, that's around 73,000 or so. Once you're back above the 200-day moving average on Bitcoin, that's going to be a big, that'll be a big deal because we've been down below this area since October of last year. So we've been struggling in this downtrend with Bitcoin. Again, as I've been saying, and I'll probably do a podcast episode on crypto, specifically Bitcoin and Ethereum and a few others very soon, we haven't done one in a while. But having been in that market now for 12, 13 years, I follow it really closely. And I'm of the opinion that by October, as I've been telling our members now for many months, that will be near the end of the typical downtrend cycle that lasts around 13 months. So as we get closer to October, I suspect we're going to start seeing some more green shoots in the crypto space. We might get one more final flush down. I would not be surprised at all to see us hit another new low in Bitcoin for 2026 before going higher, but we don't have to. Overall, things are beginning to look a little better for Bitcoin, although there is a lot of overhead resistance ahead. But what I would tell you is the best thing you can do on a chart with Bitcoin is to take a weekly chart of Bitcoin and apply a 200 moving average to it. That'll give you the 200 weekly. Make sure it's a weekly chart. Apply a 200 moving average to the chart, and then you'll have the 200 weekly moving average. Watch the price around that level. And you'll notice right now that we are back at that level. We've been sitting there for a few months now, and we're trying to get some escape velocity from it. Right now, we are actually rebounding or bouncing from that rising 200 weekly moving average. That is a bullish sign. That's the area I would be watching very closely if I wanted to be tracking Bitcoin in a serious way. We have a lot of charts that we share with our members each week here at followthemoney.com/charts. All of our members can log in. They can take a look at all of the charts we put up each and every weekend. We also put out a weekend report with our Aristocrat leaderboard update, our ETF leaderboard update, our crypto leaderboard update. We are tracking all kinds of markets for our members, keeping them on the right side of the trend. If you're not currently a member, just simply go to our website, followthemoney.com/join. Check out the plans and pricing. Find a plan that's right for you and come and join our community. We'd love to have you. All right, well, let's take a quick break and we'll be right back with our concluding thoughts. All right, friends, welcome back to the final moments of today's broadcast. And before we close out today, I want to leave you with a simple thought. Markets are always going to give us something new to worry about. One week it's inflation, the next week it's interest rates, then it's oil, then it's the dollar, then it's some sort of geopolitical tensions, and then there's an earnings report, or then there's some new technology that promises to disrupt everything. It's easy to become so distracted by the daily movement of prices that we lose sight of what investing really is, right? Investing is ownership. When you buy a stock, you're buying a small piece of a real business. And when that business earns profits or generates free cash flow, or it shares a growing portion of that cash with its owners, then you receive a dividend. And then if you reinvest that dividend, you accumulate more shares, and those shares produce more dividends. And over time, the company may raise the amount that it pays you. And if you keep doing that year after year, the income grows and your share count grows, and the compounding just continues to add up. Now, of course, for that to work out, you have to be wise, right? You can't chase a high yield simply because the numbers look attractive. You want a quality business. You want strong cash flow. You want a company that has manageable debt. And you want dividends that are well covered and capable of growing in the future. And of course, you always want to remain mindful of the trend. That's why we combine fundamental strength and technical analysis here at Follow the Money. We want to know what we own, why we own it, and whether the evidence still supports the original investment thesis. Once we finally do all the hard work to find the quality investment, the next biggest challenge is patience. That's probably one of the hardest parts of all. Because if you pay attention to the noise in the financial world, it's constantly trying to make you impatient. There's always another stock that's moving faster than yours, right? There's always another investment that promises greater returns. But if you constantly abandon the sound strategy in search of something more exciting, that's one of the quickest ways to short-circuit the compounding process that could be working in your favor. The power of dividend growth is not found in what happens over the next week or the next month or the next earnings cycle. It's found in what can happen over the next decade or two. So as you review your own stock portfolio, maybe after listening to this episode, don't just look at what your investments are currently paying today. Ask yourself whether those payments can grow. Ask yourself whether the companies can continue to generate the cash needed to support those payments. Look through your portfolio and ask yourself, are these quality investments? And then ask yourself whether you're willing to give those high-quality assets enough time to grow. And that brings us to today's final word. And that is, the most successful investors are not usually the smartest people in the room. They're the ones who remain patient long enough for quality and compounding to work together in their favor. Notice I didn't say that you have to predict every turn in the market or discover every winning stock. And you also don't have to be the smartest person in the room. But you do need a sound strategy, you need discipline, you need to focus on high quality assets, and then you need enough patience to allow compounding to do what it does best. It starts slowly and grows quietly, and then given enough time, it can produce results that once seemed impossible. Well, that's going to do it for this edition of the Follow the Money podcast. I'm Jerry Robinson. Thank you so much, as always, for listening. Be sure to subscribe to the podcast if you haven't already, and share this episode with somebody who could benefit from it. And visit us online at followthemoney.com if you have any questions. And remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right here next time. Until then, God bless.
Is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.